In this video, we will talk about indicators that will help you understand the market movements as much as possible. Enjoy your viewing. Moving averages. This is one of the most popular indicators that helps determine the overall market trend by smoothing price data. Examples include the simple moving average, SMA, and the exponential moving average, EMA. Relative Strength Index, RSI. The RSI measures the speed and change of price movements. The RSI values range from 0 to 100, and the indicator is often used to determine overbought or oversold conditions in the market. MACD, Moving Average Convergence Divergence. This indicator monitors how two moving averages converge and diverge, which can signal the beginning or end of a trend. Bollinger Bands. Bollinger Bands consist of three lines: a simple moving average, usually 20-day, and two lines plotted at a distance of standard deviations above and below the SMA. These bands help to assess the volatility and potential reversal points of the market. Now let's take a closer look at each indicator. Moving averages, MA, are fundamental technical analysis tools used to smooth price data and determine the direction of a trend. They represent the average value of an asset's price over a certain period of time. Here are the two main types of moving averages. Simple moving average, SMA. SMA is calculated by adding the closing prices of an asset over a certain number of time periods, for example, days, and then dividing this amount by the number of periods. Exponential moving average, EMA. The EMA gives more weight to recent prices, which makes it more sensitive to recent price changes compared to the SMA. The EMA is calculated using a more complex formula. Traders choose the type and length of the moving average depending on their trading strategies and goals. For example, short moving averages may be useful for short-term traders, while long moving averages may be better suited for long-term investors. Moving averages can be used to generate trading signals. For example, when a short moving average crosses a long moving average from top to bottom, this may be a sell signal, bearish cross. If the short moving average crosses the long one from the bottom up, this may be a buy signal, bullish cross. It is important to note that while moving averages can be useful tools, they do not
Information
provide
level
accurate
3,
forecasts and
entrance
should
to
be
the
used in
gate
combination
72-129
with other
in the
indicators
Hyatt
for
Hotel
analysis
Atrium.
purposes. The
Paging
trend should be worn
Robert
knowing that they
Whitman,
are based on
Robert
past data
Whitman.
and may lag
Please
behind
meet your
current
buy
state of the market.
information book
The
level 3,
Relative Strength
entrances
Index,
to the gate
RSI, is
72.
a moment oscillator that measures the speed and variation of price movements. It was designed by J. Wells Wilder as a popular technical analysis tool. The RSI ranges from 0 to 100 and is usually used to determine overbought or oversold conditions in the market. To calculate RS, the following steps must be followed. Divide the time period into intervals. Usually 14 days are used. Calculate the sum of all positive price changes, gains, and the sum of all negative price changes, falls, over this period. Find the average value of the gains and the average value of the drops. Divide the average value of the gains by the average value of the falls. This will be RS. Interpretation of the RSI. Overbought. When the RSI exceeds the 70 level, it may indicate that the asset is overbought and a price decrease is possible soon. Oversold. If the RSI falls below the 30 level, this may signal an oversold asset and a potential price increase. Divergence. If the price of an asset forms new highs and the RSI does not confirm these highs, does not reach new highs, this may portend a trend reversal. Traders can use the RSI in combination with other indicators and analysis tools to confirm trading signals. It is important to remember that no indicator is infallible, and other aspects of the market should always be taken into account, as well as a thorough analysis before making trading decisions. The MACD, Moving Average Convergence Divergence Indicator, is a technical analysis tool that is used to determine changes in the strength, direction, momentum, and duration of a trend in the securities market. It was developed by Gerald Appel in the late 1970s. How the MACD works. The MACD consists of three components. MACD line, the difference between the 12-day and 26-day exponential moving average, EMA, of the asset price. MACD line, EMA. EMA, MACD line, EMA. EMA signal line, the 9-day EMA from the MACD line, which is used to generate trading signals. Signal line, watch your EMA from the MACD line. Signal line, EMA from the MACD line, MACD histogram, a visual representation of the difference between the MACD line and the signal line. MACD histogram, MACD line, signal line. MACD histogram, MACD line, signal line. Interpretation of the MACD. Intersection of the MACD line and the signal line. When the MACD line crosses the signal line from bottom to top, it can be perceived as a buy signal. If the MACD line crosses the signal line from top to bottom, this may be a sell signal. Divergence. If the price of an asset reaches new highs and the MACD does not confirm these highs, this may indicate a weakening of the current trend. Histogram. An increase in the MACD histogram in the positive area may indicate an increase in the uptrend, while an increase in the negative area may signal an increase in the downtrend. Traders often use the MACD in combination with other indicators to avoid false signals. It is important to remember that, like any other indicator, the MACD is not ideal and should be used in the context of general market analysis. The Bollinger Bands indicator is a technical analysis tool developed by John Bollinger in the 1980s. It is used to measure market volatility and determine overbought or oversold conditions. How Bollinger Bands work. Bollinger Bands consist of 3 lines. Average band, the simple moving average, SMA, is usually over a 20-day period. The middle lane, SMA, middle band, SMA, upper band. The middle band plus the standard deviation of prices multiplied by 2. The upper band, Quarn SMA plus 2x standard deviation. Upper band, SMA, Plan Quaxig standard deviation. Bottom band, the middle band minus the standard deviation of prices multiplied by 2. The lower band, Maasern SMA, 2x standard deviation. Lower band SMA, 2x standard deviation. Interpretation of Bollinger Bands. Band compression. When bands narrow, this indicates a decrease in volatility and may portend a significant price movement in the near future. Band widening. An increase in the distance between bands indicates an increase in volatility and may be accompanied by strong price movements. Trading signals. Prices approaching the upper band may indicate overbought, while prices approaching the lower band may signal oversold. Traders often use Bollinger Bands in combination with other indicators such as RSI or MACD to get more accurate trading signals. It is important to remember that no indicator should be used in isolation, and a comprehensive market analysis should always be carried out before making trading decisions. These indicators can be used in combination to get a more complete picture of market conditions and help traders make informed trading decisions. It is important to remember that no indicator guarantees success, and they should be used in combination with other methods of analysis and personal experience.